Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I will be your host, and I'm joined with my good friend once again, Doug Heagren. Hey, Doug.
How you doing, Kirk? Hey, listen, it's a good day to start. I got 4 brand new rackets that I just got done restringing. Anybody out there that plays tennis knows what it's like. It's just the sexiness of having new strings on your racket. And then just about 5 minutes ago, my glasses broke. So, it's a mixed bag, but as long as I can get out there and put spin on the ball, I'm a happy man. So.
You know what, Doug? It is Cinco de Mayo today, and I guess the way my thought is, don't worry, be happy. Let's go drink a margarita.
That's right. And by the way, I was just reading an interesting statistic on Cinco de Mayo for anybody out there that's listening. I've been in Mexico during Cinco de Mayo, and it is a completely 100% American holiday. Like, they don't even have a national holiday for Cinco de Mayo. It's completely driven and created here in the United States. Charter actually had something about that today, where basically I think it was intended more to be a holiday here in the United States to give Mexican nationals a little bit of a reprieve, based off of the fact that over 40% of Mexican workers are doing 6-day work weeks. But they could see this. I guess they're saying now that they could see their hours slashed from 48 to 40 thanks to employee-friendly legislation that passed out of a committee stage last week. But again, Cinco de Mayo is one of those things I think that really became an American holiday to support the number of Mexican workers that were here in the United States. But down under the border, they couldn't care less. It's a very, very quiet holiday.
I think it's funny how we in this country decide that we're going to apologize for the rest of the world. It's and come up with our own ways. So I read something the other day, and I don't want to get political, but I found this fascinating. There was a trend, maybe it was 5-10 years ago, where there was this term Latinx, and people were trying to use it to describe people who are more Latin origin, which, if you're trying to describe people, they're coming up with a unified term, which of course in itself doesn't always work. But so they came out with it, and then a bunch of Latin people came and said, this is a ridiculous term. We don't like this. Why did you give us this term? Like, it wasn't like they gave themselves. It was like we decided to give them, as we do in this country. We decide what's right. But I think what's fascinating about Mexico is I went down to Cozumel for a wedding a bunch of years ago, and I had I had the opportunity to spend some time down there, and we're right. We went through Cancun, and so we had some great dinners, and I was eating Mexican food basically, and I was surprised at how none of it was spicy. And I'm expecting spicy Mexican food like we have here. Like, it's not spicy. It's really good, but there's like no spice to it. I was just laughing, just recalling and how like we've like bastardized Mexican food, as Americans as we do with every food.
That's what we call Mexican food, right? And the debate between Tex-Mex and New Mexican and flour tortillas, corn tortillas, which all have distinct regional roots to them. But them fighting words there when you start getting into what is Mexican food. So.
Yeah, it's interesting because what else is interesting I learned about, and we feel like we're doing an investment podcast. We're talking about food, so there's another interesting thing.
We want to keep people interested now and then, Kirk.
It's Cinco de Mayo, Doug. You need to have something with your margaritas.
Absolutely.
So one of the things I found interesting as well is I spent some time in Cuba many years ago, 10 plus years ago, and went down there for a trip, and it was great. It was a lot of fun. Learned a ton about Cuba, and it's such a beautiful place, and it's. The best part about Cuba, outside of the fact that it's just the land and there's nothing there because people don't have any money, so they're not building on the ocean. But what amazed me was like Cuba is the people. The best part about Cuba is the people, because they live in one of the last communist countries, depending on what you want to call it, communism, but technically one of the last communist countries, and these people have nothing. They literally.
I'm sorry. Excuse me.
What?
Dictatorship? Excuse me.
Yeah. It's no. They're free, Doug. They just don't have any rights. But what's interesting about Cuba is, the culture there is fascinating. Just the history and the people. But the best part is the people, right? These people have absolutely nothing. They're dirt poor. They have nothing. All they have is conversation and music. and they might have more, but I doubt it. But the music is great. The people are great. That you could strike up a conversation with anybody.
The cigars.
You could pass out drunk in what seems to be the shadiest, seediest part of Havana, with like $100 bills like stuck in your like pouring out of your wallet, and it would be there in the morning because everyone there is so afraid of the government. So they just like, and yes, there's no crime because people just disappear in the middle of the night. But the point is like the people, the conversations are really great, and the music is just fantastic. And if anyone gets a chance, I highly suggest you go there. But one thing I did find out there, which was amazing, is, and I know probably people know this, but things like Coca-Cola and Pepsi and all the sodas we have here are made with corn syrup because we have farmers that produce corn. And so one of the things that you go in the rest of the world, and soda is made with sugar, like real sugar. I'm like,
Yeah.
really? Right? It's made with sugar, not corn syrup. It's actually better. If you have it in these other places, it's so much better than it is here. And because we have the lobbyists or cheap corn or whatever it is, it's made differently. And I have to say, international traveling, even if you're buying Coca-Cola, is much better.
Well, Costco's dipped into that. If you go to Costco, you can buy Mexican Coca-Cola with the real sugar in it, and it's an incredibly popular item there because it Coca-Cola created New Coke, right? And everybody can't stand. So then they came back and created Coca-Cola Classic, but they really didn't change the formula back to what Coca-Cola Classic was. A Coca-Cola Classic had real cane sugar. And there is absolutely, without question, a difference of flavor. I want to welcome Lena, who said, "Is this a live stream? What's being discussed? Seems interesting." Yes, we are. We're just getting started. Cinco de Mayo. By the way, but we are going to get into some actual financial stuff today. But hey, Kirk, I did want to say, speaking of the master, the new master, you're free, but yet you're a slave, right? Listen, if I saw something for yesterday, the 4th of May, lots of Star Wars memes, right? So may the 4th be with you. And I thought this was a very funny meme somebody created for Star Wars. It was going back to the beginning, the episode 1, when Qui-Gon Jinn comes to Anakin and says, "Anakin, I have freed you from slavery," right? But then the joke says, "Now call me master."
So, that's really good.
So what is your definition of freedom?
That's really good.
Oh.
Well, I think yeah. So I think what we can do here is we can use this as a good opportunity to kind of segue into, perspectives on the world. We spent a first 5-10 minutes talking about anything but finance, but I think one of the things we do in the show is we like looking at things from different perspectives, and we do it because everyone listening to the show has their own perspective, just as I have mine and Doug has his, and Doug's perspective and my perspective, while be it similar, are certainly not the same. And our perspectives are tainted by our life experiences. And by nature, if you had a certain experience and I didn't, you're going to have much more to say about it than I will, right? Mm-hmm. So my experience going to Mexico, I had a great meals in Mexico. None of it was spicy, and I'll bet people listening to this said, "Hey, I did have a spicy meal. What are you talking about?" Right? So it's not what we try to teach on the show is the value of perspective. And this is why we don't really get into politics, right? Because politics are just perspectives. Mm-hmm. Who knows which one's right, which one's wrong? I can't say. I'm not smart enough to know who's right or wrong. And quite frankly, I don't think anybody does. But that's my perspective, right? So when you stop and think, like somebody gives you their opinion, it's just an opinion, right? The facts, there are very few facts in this world, right? There, even if you look at like science and math, and you can look at certain laws. They're laws until they're unproven, right? The world was flat before it was round. We were the center of the universe before it was heliocentric.
Flat again, Kirk. And Pluto's going to be a planet again. Just you watch.
Right. So the point is things are always changing. And I think in the world we live in, it becomes increasingly challenging. Because if you think about like AI, for instance, you think about like things on Twitter and the news, what you see half the time isn't even true. And I was listening to this podcast and that was brilliant. What they were saying is if you look at the news stations, now I haven't watched the news in 20 years, so don't think I'm one side or the other because I just don't watch it at all. I think it's all garbage. But if you look at both sides, there was a time, and it might have been prior to 20 years ago, where you'd get a news story and both sides would report on it, right? And they'd give their own opinion. Actually, way back there was one, right? It was Walter Cronkite or whoever else was on, but there was like only a handful of people, and they kind of told the news, and it was less perspective and more fact. Now it's all perspective and almost no fact. And what's interesting is not like 20 years ago when you had people on one side. I forget who it was 20 years ago, maybe like Chris Matthews and Hardball or something like that. Then you had the other side, and they had their perspectives on the same thing, like the Clinton impeachment. Like, oh, is he bad? Is he good? I don't know, but they had their opinions, right? But now you see the news, both sides, they don't even see the same news, right? One side shows this piece of news, the other side doesn't even show it, right? And then the other side has news, the other side doesn't show it. So it's like if you're only watching one, you're not even getting the news. You're just getting opinion pieces that are basically put together by a biased perspective. Now, you might believe in that perspective. I'm not saying it's wrong, because like I said, we're talking about opinions. I don't know what's right or wrong, but I know that if there's two parties, right, and they both have their opinions, they're looking at the same set of facts and they have different opinions, then it doesn't mean one of them's right. Both could be wrong, right? Who knows, right? Because they're just perspectives. So we try to teach that, and we try to overlay that on finance, because while we don't like talking about politics, and there's plenty of fodder to talk about this with politics. I mean, we could do this we could have a full day show to go through this, but I don't really enjoy politics, and Doug doesn't either. So we're getting in finance. But I'm using this to start the conversation with finance, because as we go through this, and I want to start with this story, right? And I think all of you have heard it by now, but First Republic was taken over by JP Morgan on Monday morning, right? We talked about this on Friday. There were rumors that First Republic was going to get taken over by the FDIC over the weekend, and apparently they worked out some deal Monday morning. I think it was around 11 o'clock, where JP Morgan agreed to take over First Republic Bank, and the terms were, I think, kind of I don't know. Maybe Doug can talk about the terms. I'm looking for them here. I can't find them, but the terms were borderline ridiculous, in that JP Morgan got a great deal. I think the deal was. They bought 18 billion in net assets at market by paying 10.6 billion, so booking about a 7.4 billion profit just by taking it over. And I'm sure there also was subsidized financing and loan loss sharing and yada yada yada. I'm sure I'm putting people to sleep.
Kirk, you've actually got a copy of a balance sheet image you can show there, just to kind of talk about some of the things. I mean, this deal is immediately 500 million accretive to net income, and has a 20+% IRR with a $2.6 billion post-tax profit to be recognized immediately. So when you say, oh, they agree, JP Morgan agreed, are you kidding me? JP Morgan lapped that up like bunch of toddlers at an ice cream parlor. I mean, this is an unbelievably delicious predatory deal for JP Morgan, where they basically take almost no risk and added billions of dollars of size to their already behemoth position amongst the world of finance.
Yeah. So to put it bluntly, it would be like somebody walking up to you in the street and say, "Hey, if you take this box, I'll give you $1,000." I mean, that's basically what they're saying. And I guarantee you nothing in that box is going to be anything that you don't like, right? And if it is, I'll take it back from you, right? It's kind of like that ridiculous. It's basically what it is, right? They're taking a black box because they look at the numbers. They don't really know. There's a lot of question marks, right? You're taking over a bank that has some question marks. I would argue that most of the problems are due from a quote unquote bank run more than bad assets. Although
it's a liquidity issue. It's not
right.
a bad investment issue. And
right.
That's why they're saying, I mean, JP Morgan, could get these at $150 billion current value and hold to maturity. They'll make another $23 billion on those immediately. And they only paid $10.6 billion to the FDIC to get this. This is incredible. $10.6 billion for $18 billion in net equity. I mean, maybe there'll be some defaults along the way, but for the most part, these banks this is not the subprime. Now, it's a different story we can get into, but this is not the subprime issue. This is just these banks held on to hard assets, which again, we've talked about with real estate and regular retail investors that have so much equity and ownership of assets that you can't easily liquidate. And what have I said time and time again? The number one cause of financial stress is lack of access to capital. When all of a sudden you need the money, is it going to be there? And that's exactly what these banks are going through. These banks sit there and all of a sudden their customers said, I want my capital, I want my money. And the bank didn't have access to it because they had deployed that capital into long-term treasuries, which they intend to just sit and hold. And those long-term treasuries, if resold on the secondary value, have been crushed because of rising interest rates. If the bank never has to sell these things, it's not a problem. They would mature back to par. They collect their interest. Everything's good. But the bank run on forced the banks with a lack of liquidity, forcing these banks out. And JP Morgan is like vultures in the sky. I'm going to pounce on this. I'm going to eat delicious, healthy, fresh carrion because it's really, really, really good assets. But guess what? First Republic didn't have access to capital. Learn from this personally in your own wealth. You cannot be in a position of security and of financial freedom if you have everything tied up and nowhere to go if you need liquidity now. And we're going to see a continued fallout because of this. It's all the stuff we've tried to teach that unfortunately, again, we go back to the stuff you learn and the stuff you see on Twitter and the places where they say, just have all your money deployed, buy real estate. Guess what? When the dominoes don't fall the right way and all it takes is a spark, bam, the whole house comes crumbling down. And unfortunately, this goes back to half truths. A lot of what you have been told about how to allocate your wealth is half truths. Yes, you need to be saving. Yes, these can be good assets. But a lot of what you see out there, again, is opinionated, telling you only go in this direction because that's all we know, or maybe there's a personal vested stake in it. And then when you deploy all of that with no flexibility and no access to capital, then all it takes is a spark to bring that completely down. The one last thing I wanted to go back to, Kirk, you were talking about differences of opinion and on that whole Cinco de Mayo thing. We talked about Cuban nationals. You compare that to a lot of Latin American nationals from different areas, completely different perspectives, right? Not getting into the politics, but South Florida has a very right-leaning Latin American population based on experiences they went through in Cuba that differs from a lot of Latin American immigrants in other areas. Again, I'm not going to get into those balances of those opinions, but again, it just wanted to add that on about how what you experienced leads to how you frame your mindset. So I know I went backwards there, but guys, this JP Morgan opportunity just continues to make a banking sector consolidated by a handful of behemoths. And I also want to add that before this, there were laws in place to prevent companies like JP Morgan from acquiring these small regional banks in order to prevent this massive monopoly. And the FDIC and the federal government just went, whatever. Here you go. And guess what? The consequences of this are something we're not going to realize for some time. Sorry, Kirk.
Yeah, no, it's good, Doug. So I want to mention a few things about this before we move to a different topic. And one is the difference between liquidity and solvency. And this was actually a problem in 2008 too. And a lot of people confuse the two. So I want to kind of bring it up here because I think what people, and when Signature Bank and what was the other one that went under? SVB. When Silicon Valley Bank, when they both kind of went under at first, people were like, oh my God, it's a bank run. Like, well, not yet. Like, we weren't seeing a bank run at that point. We're saying, we said it on the show. Like, the question was raised a bunch of times through email, and I appreciate all listeners saying their emails. But like, the question was like, are we having a bank run? Like, well, it's really too soon to tell. So if you look at history, and I'll give you some examples to how to think about this. You look at 2008, right? 2008 happened, and it was a big problem, global financial crisis. The whole system pretty much was borderline, imploded, and it was a problem. And when it started to turn around, the markets went up. People were like, "Oh, it's great," And if you look back at history, you're like, "Well, in March 8th or 9th or whenever it was, that's when it turned and everything got good." No, that's not when things started to get good. That's just happens to be where it bottomed. For years after that, people were still worried about, is my cash safe? And and even though the markets went up, people were still concerned. And so what was interesting is what ended up happening is over the subsequent 4 or 5 years, bodies were still coming to the surface, right? You were still getting like, all right, the storm's over, and like a year later, right, a body floats up to the surface, and like this company goes bankrupt. Then you have MF Global go under, and that was because of some stupidity with Corzine. But basically, if you look at some of these situations, it doesn't all happen at once. Like in like 1929, when you had was it Black Friday, or you basically had the bank runs where everybody just pulled their cash out, and all like thousands of banks. I think it was like 3,000 banks or something crazy went under in that time because of bank runs. And the whole point of the FDIC insurance is to keep bank runs from happening. Now, the reason that it protects banks is because if a bank takes in $1 million, they'll lend out $10 million, right? They'll turn a million into 10 million, and that is actually what causes inflation in the system, because as they lend it out, there's more money in the system. So $1 million turns into 10 million through the bank. So technically, the banks create the money, not the government, which the government does make it, but generally it's mostly made through the banks. And so when the banks are making these loans, they had $1 million, but now they have 10 million in loans. Well, now they don't have that $1 million in cash. So now they got to take more depositors to make sure they have enough cash, because if somebody decides, hey, I want to take my cash out, well, they get no cash to give them, right? So banks have to balance their balance sheet, their cash flow, to make sure that on any given time, not more than, let's say, 5% of depositors pull out their money, right? They have to have some sort of balance in there that says we're comfortable that not more than 5% of people are going to take out their money. But what if 10% of the people come in and take their money out because they're afraid of a bank run? Well, it's not a solvency. It's not like the bank made bad loans, which is a solvency problem. If the bank is full of bad loans that aren't worth anything, well, the bank is insolvent. They're basically defunct because they don't have any value because the loans are worthless. However, if you have your cash, instead of issuing loans, let's say you buy U.S. Treasuries, which is for the most part what a lot of banks were doing because they weren't issuing debt. So they weren't making loans. So they're basically buying U.S. Treasuries. Well, that's fine, but if you're buying a 30-year Treasury and you need the cash tomorrow, well, you have to sell it to get that cash. Well, the problem is the Treasuries went down in value last year. I think it was 25%, something like that, maybe 30%. 30 years, I think we're down close to 30%. So you're down like 30%. Well, I don't want to sell it at a loss because I took that $1 million, turned it into 10. Well, I only had $1 million, right? So if you take away 30% of that, well, I can't pay everybody. I don't have enough because it's basically, it's not a defaulted loan, but it's worth less if you have to pull it out. So the point is the banks didn't manage their liquidity. So it's not a solvency problem, it's a liquidity problem. And the liquidity problem is what all of these banks are having, because we're not having a tidal wave of bad loans or problem loans or subprime. Not to say that isn't out there, because there's definitely some crap out there. I've seen some 100% borderline ninja loans that have happened in the last year. So not saying that's not out there, but in general, it's not a solvency problem. It's a liquidity problem. And the only way you get out of the liquidity problem, which most of these banks have, is by buying short-term treasuries, which are more liquid, or you find more depositors, right? Or you sell it and hopefully you have enough cash at the end to pay people, or you get bailed out. I mean, you're really stuck at some point if you were dumb enough to buy all 30-year treasuries and you have no liquidity. That's just a dumb move. And I think that's what happened with Silicon Valley Bank, to my understanding. And a bunch of these other banks have different problems, but similarly, where the rising of interest rates has caused this to happen. Now, the big issue, and this is why initially when Silicon Valley and Signature went down, people said, well, it looks like a bank run. I'm like, let's wait, right? We're not sure yet, because it wasn't clear at the time it was a bank run. We saw signs that things were heading in that direction, but we weren't sure. So we can't just say, oh, it's a bank run. A, that'd be irresponsible of us, and B, it's just not true, right? And we're not looking to get headlines. I know people out there claiming bank runs because they want headlines. That's not what we do. So we look at this and we'd say, all right, well, First Republic Bank was on the ropes since that first week. And so finally people started bailing on them because they realized, like, all right, we're not sticking around to check this out. And the trend was, and we showed this last week, is all of, well, not all, a huge amount of people's deposits are now being put into the big banks because they're considered too big to fail. So you look at the stock price of the regional banks, the community banks, they're dropping off the cliff like a stone. And the big banks are doing just fine because people are putting their money there because they figure, hey, they'll be safe no matter what. Well, as long as you keep your money under 250,000, it's safe. We don't know when you'll get it back, but it's safe. Technically it's insured. So I think the thing to think about is, as you think about your own financial situation, is your cash safe is a really important question. Are you at a bank that is questionable or borderline? And some banks have been thrown out in the news. I think West Pacific, and there was a few others that were put out there. I don't know if that's true. I'm not breaking news here. I'm just saying people have proposed that because of the nature of where they are and their customers. I'm not a bank analyst. I'm not going to sit here and say which bank is going under. Just make sure you do your diligence on your bank and make sure that they're not doing anything stupid. Do the research on them and just make sure you have under 250,000. Because even if you make the wrong choice, which many people will, and that's okay, the FDIC will bail you out as long as it's under 250,000. Now, the problem is if people stop believing the FDIC is safe. So the Federal Reserve could just really solve this problem immediately. They could come out and say all money at banks are FDIC insured. That's what they could do to solve this problem. They could easily solve it. I'm not saying it's the right thing to do. It creates a whole bunch of more problems. I'm just saying if the Federal Reserve wanted to solve this, that is one solution. They could come up with 10 more solutions. I can think of a dozen off the top of my head. This is one that would immediately solve that problem. It would cause unintended consequences. But anything they do will cause unintended consequences. The bailout of the financial system in 2008 caused unintended consequences. Even though most people would agree it was the right thing to do, at the same moment, you basically bailed out bad actors and paid people a lot of money for doing stupid things. And that caused a moral hazard problem, which basically says next time around, we're going to do it again. And it's too big to fail. So we're going to do it even worse. So they created more problems. But I mean, we've got our system, and Lena makes a point on LinkedIn about the financial system's crumbling. It's been slowly crumbling for decades. And the question is at what point do we hit the wall? I don't know. I don't know where that wall is. I suspect it's going to be in the early to mid 30s, where we talk about where a lot of the financial crises all come together. So you got Social Security, Medicare, and pensions are all basically going bankrupt at the same time. That I could see as an inflection point that you want to be aware of. That is not something you should go jump out of your window, your first floor window today. You shouldn't put 100% of your money in gold today. It's not a today problem, but it's a problem you should be thinking about 10 years from now and how this is going to how the implications are going to go. So we have 10 years to figure out where we're going to be between now and then. Now, the government could very easily come out and say, well, we're going to back everything. We don't care. We're just going to print more money. And it solves that problem. I don't like that problem, but it solves the problem. So
it's certainly been some of the things that they've done over the last 2 months. It's kind of as scary as that might be. It seems to be where they're hinting they might go.
Right. So if you think about, and I'm going to present this chart before I hand over to Doug. So there's two charts that I found this week that I thought were interesting. They were Gallup polls. Whatever you think of Gallup, I mean, I don't, when you talk about politics, who the hell knows? But, here's a Gallup poll. So it's one of the pollsters that people use, right? Well, Americans worry about the safety of banks. So this is the percentage of people that are worried. Very worried is 19%. Moderately worried is 29%. Not too worried is 30%, and not worried at all is 20%. So you pretty much have close to 60% of 80% of the country that has some worry about this, and you have approximately 50% of the country is moderately to very worried. That's a lot of people, right? Now let's take the next one, right? So if we look at you look along political parties, we don't like talking about politics, but I'm just going to mention it because I think it's always interesting. This is based on Republicans, Independents, and Democrats, how worried they are. Democrats are less worried than Republicans and Independents on a party identification. On an education level, college degrees are less worried than people with no college degree. Annual household income, people who make over 100,000 are less concerned than people who make more than 100,000. So I just So like less than 40,000, less than 100,000, basically more worried. So it's just interesting to see the dynamics. And I don't even know if these are accurate, right? I'm just pulling these up because they're interesting. And how should we look at this? Well, I wouldn't read anything into this. I would just say, look, the concern that people have, there's enough people concerned that banks are whether their money is safe or not. That's what I would take away from this. At least 50% of the public, up to 80%, are concerned enough about their banks, which could be a problem, right? If those people are concerned enough to start pulling their money out, that's going to become a problem. That is the problem. It's not the banks. The banks are a problem, but that's not the problem. The problem is the people. Do you trust your bank? If you don't trust your bank, then you and a whole bunch of other people will be the ones to cause the run on the bank. That's what we need to understand about the concept of this, is that no matter what people say, if a bank's going to fail or not, we've been telling you on this show for about 2 years, cash is king. I don't care what Ray Dalio says. He says cash is trash. I think cash is king. And by cash, I mean, secure cash, like, things like short-term US treasuries or things that are as close to guaranteed as you can get, right? There's no such thing as a guarantee, but as close to that as you can get. So that's what you want to have, right? If you're worried, then you shouldn't be taking a chance with your cash. You need to have your liquidity. If the banks aren't liquid, you need to be liquid. You can't worry about not paying your bills because your bank went under. You need to make sure that you can take care of yourself and your family. If that means having two banks, if that means putting money in a brokerage account, whatever it is, spreading the risk around so that you're not susceptible to other people's problems. And in crisis times like this, I've been through this a few times. You need to take charge of your financial situation. You can't delegate it to others. If you're doing it yourself, you can't hope your bank's doing a good job. If you're doing it yourself, you can't hope that, Apple, Microsoft, Tesla, all these FANG stocks, you can't hope that they're going to save you from market downturn. If you're using an advisor, your advisor hopefully is smart enough to understand what's going on. If they're not, find a new advisor. But either way, you should still be involved in the conversation. You should be asking questions. Ask good questions. If your advisor knows what they're talking about, they're going to be able to answer them. If they don't, then find a new advisor. But now is a time not to take a chance on question marks. If you have a good advisor, then spend some time and get a good understanding of how they're thinking and what they think of the market. If you don't have a good advisor, do it yourself, or find somebody good who can navigate this. If somebody has not been around for more than 10 years, they're not going to understand how to navigate this. This is a tricky environment. Yeah, the markets are up. It looks great when the markets are up. Everyone feels great, but it doesn't mean things are okay. The markets could be at all-time high, and we could have bank failures across the country, which would cause problems. I'm not saying that's going to happen, but I'm saying that just because one thing shows one thing, it doesn't mean it's true, right? The peak of the real estate market was 2005. We didn't have a crash till 2008. It didn't mean real estate was fine until 2008. It just meant the market didn't appreciate that until 2008. Much like now, the market is not appreciating real estate prices and the drop that they're going to have. It's going to happen, but it takes time. So just understand that you have to be patient and you have to just be thoughtful about your decisions in times like this, because the risks are real. All the risks that we try to protect clients against, they're very real. They're not always real, but they're right now. There's a time to be extra careful, to dot your I's, cross your T's, and I don't mean run around like your hair on fire. I just mean just make sure you're doing your diligence. Make sure you're protecting yourself. Are the custodians safe? Is your bank safe? Just look at all the things you take for granted. Now's not the time to take things for granted. Now's the time to be sure. If you have a question, ask a question. Ask your bank. Are you FDIC insured? I think all banks are, but just ask. What's your ask about see if you can see their balance sheet. Now most private banks won't show you that, but see what you can do to get some confirmation of that. Public traded banks, you can get their balance sheet, but do what you can to try to get some insight into this. So what are your thoughts, Doug?
Well, one of the first things that you talked about that I think is really important, and I've talked about this before, is an analogy that likens financial planning to golf. Okay? We've used this analogy at times because one of the things you're going to find out there is, again, as I mentioned, everybody's got an opinion. This is going to be the best thing you should buy. Insurance people will say they've got the best product ever. Stock jockeys will tell you the best thing in the world is absolutely, anything that's going to be in equities, and you can't go wrong with the S&P 500. The reality out there is the most Americans, just like these banks, are not in balance. Okay. There is a combination of mixing your cards, mixing up the clubs. There's no such thing as a good club, as a bad club. Yeah, insurance can be a great thing. It could also be the wrong thing. Stocks could be a right thing. They could also be the wrong thing. If you're just starting out and you don't have a cash reserve, no, you shouldn't have stocks, right? If you got credit card debt, you should pay it off. You shouldn't have stocks. Annuities could be the right thing, the wrong thing. Cash, right thing, wrong thing. The reality is, it's probably a mix of all those things. You can't play 18 holes with the same club. Nobody's going to sit there and hit the ball into the sand trap and try to figure out how to get it out with the driver. But that's what most Americans are trying to do. Most Americans are driven by fear and react with greed. Okay. What does that mean? It means that there is this predominant belief that the greatest way to achieve wealth is going to have the maximum amount of returns you possibly can. It's why that there is a rhetoric out there around how bad fees are and how bad interest rates are. Listen, I'm not saying you want to pay more than your fair share of fees and more than appropriate fees. I'm not saying that you want to go out there and just take on a lot of ridiculous interest, but sometimes interest can be your friend. Paying interest in order to acquire real estate under a smart investment is worth it, right? If you may not have the cash, or it may be better for you to keep the cash, pay someone else, because the money that you keep has the ability to earn interest too, right? This is what we call the truth about financing. The truth about financing is that there's a cost to any transaction you make. You're either going to pay interest to someone else for the use of their money, or you're going to pay interest or lose interest by using your money, what I call self-financing, and you'll never have that money grow for you again. But the key is that there is this belief that, again, well, if I have this mortgage and it's I'm paying on this for the future, look how much money I'm losing interest. But if you had $300,000 sitting around that was invested for you and you used it to pay off your mortgage, you'd also lose the interest that money could grow to. So again, sometimes these decisions are being made with extremes. Like, I don't want to pay interest, therefore I've lost so much money by this interest that I paid. Or if I pay this person, or to help me with my financial investing or planning, etc., then look how much money I would have made if I had just done it myself and not paid. And then, of course, if I hold this and it only grows by this much, that's a bad investment. Because if I'm over here and I look at the returns of the S&P 500, look how much money I could have made. I see it still. If you put this money away, you'll have X amount by the time you're 65. That's not true. I don't care what number they're giving you. That's not true. It's either going to be more, or it could be significantly less based on sequence of returns, based on a lot of things. The S&P 500 does not go up by 8% every single year, people. It doesn't, or as Dave says, 12% in a growth stock. Doesn't happen, okay? We have seen large periods where the stock market has underperformed or suffered or eroded tremendous wealth from people who thought they were all set, had all their eggs in one basket, and then when they were ready to use it, something went wrong. They weren't prepared. They didn't have other clubs in their bag. Okay? These banks didn't have other clubs in their bag. They took and invested in safe government treasuries. They were under the belief that interest rates weren't going to have an impact. Heck, as we've talked about with Silicon Valley, some of these banking executives sat on the board of the Federal Reserve. You'd think they might have the ear of the chairman and know what's going on, but yet they still had all their eggs in one basket. And then thinking long term, not a problem. If it goes down, it'll come back. We'll just let that loan go to maturity. But then all of a sudden, it took a spark. And with that spark, because of changes of regulation, because of laxing of regulation, because of the fact that, again, I'm not a big fan of regulation, but there are some places where regulation works. Like, let's not go to zero reserves in the banks, because the banks themselves, unfortunately, once again, faced by shareholders and greed, lent all that money out. And then when that money came due, They didn't have access to capital. They did not have enough clubs in the bag to weather that storm. Learn from this. This is an incredibly critical thing to be focused on, and understand in the way you plan that it is not about having everything in an area where you can get the most return. Okay. You've got to have balance in your wealth. You've got to have access to capital. You've got to have some things out there. And listen, we're going to go through cycles. The world is not collapsing. The financial system's not collapsing. Now, I could be wrong. And that's why, Kirk, I love what I've heard, somebody say on another podcast. We don't do breaking news here. We do breaking rumors, right? Because that's effectively
it's better than Breaking Bad, Doug.
It's definitely better than Breaking Bad. But the reality is that we don't know what's going to happen. There's a lot of money in this system. There's a lot of people that stand to do well off of a collapsing system. There's also a lot of people with a lot of money that stand to do better off a system that doesn't collapse. And they're going to do whatever they can to keep that system working, because that system's in their personal vested best interest. And whether that might work for your best interest or work better or against your best interest, it definitely means there's going to be more variables and more things at play here than you may anticipate that are going to keep the system going. I do want to go back to what you said in 2008. Look, we knew whether we knew or not, the real estate was in a serious crisis. The credit markets were in a serious crisis. And yet, what happened? The markets continued to go up. The economy continued to sustain until it didn't. And we're seeing some things right now to heed caution of, and I get a little bit of a transition for us, Kirk. But look, we had incredible profits come out the other day. Once again, massive profits. And there are people that are out there right now publishing, see, this market's never going to collapse. Why? Because it's different this time. Maybe it is. And if it is, great. But we're also seeing now, and we could talk about this to this week, we could talk about this in a future week, but we're starting to see that there are non-qualified loans out there. These are not subprime, these are non-prime, okay? And they are embedded. So people are like, well, this is different than 2008. 2008 had all the subprime loans embedded. There is a lot of non-prime, very poor, non-qualified debt that is out there right now. And it is starting to get to be in a position in which, Fitch and a lot of these rating agencies, and again, they've made their mistakes too. So don't believe I'm preaching their godliness, but they are saying that with those loans out there, there is an increasing level of concern over significant debt. And look at this, Kirk. 5-year ARMs, 10-year IOs, short-term balloons. This looks familiar. I've seen this before. Wait a second. Oh yeah, 2008 and before. And guess what? There are people out there that are telling you this isn't there now. This debt doesn't exist. The debt is safer than it was. It's more secure. It's more credit worthy. And listen, it all is until the spark. All it takes is all of these renters that lose their job, that can't pay. Now the landlord that might have been paying down his debt and have tons of equity still doesn't have enough clubs in the bag, doesn't have liquidity. Kirk, 2020, COVID hit. It wasn't even 30 days later that short-term renters out there were whining that they were going to be behind on their mortgages. 30 days! They didn't have enough liquidity to get past. And you don't think that that's not a risk now? Even people, here's the thing about high equity. It doesn't mean anything until everything's paid off. You're just one payment away. That's the problem with not having enough liquidity. Now, some people will translate this as, that means I need to pay my debt down faster. Putting extra payments isn't going to take care of the next payment. The real issue right now is, are you building up enough liquidity to get by that unexpected? You shouldn't be necessarily putting extra payments, especially on a 3 or 2% mortgage. You should be putting that somewhere where it's liquid. Because if you have $500,000 in one account and you get a mortgage that's worth $500,000, guess what, people? Your house is paid for. Well, what do you mean? I owe the debt. No, you have the control and the choice to pay that off tomorrow. And if, God forbid, your renters aren't paying you, you've got all that $500,000 there that you can use to get by and cover your costs and buy you flexibility. But if you're throwing all that, this is the irony. If you're throwing all that to the extra more payments, guess what you're doing? You're giving it right back to the banks. If this one thing we're talking about in this conversation today, don't trust the damn banks. Sorry, Kirk.
No.
I mean, don't trust the banks. And yet extra payments are just giving your money to the bank and say, well, I've got equity. What you can do with it? Sell the property or ask the bank to give it to you for a cost. And right now, those banks are not wanting to give any more money for a cost. So equity is worthless. It means nothing to you financially unless you can either borrow against it or sell. What matters is assets in hand, liquid assets, cash, and other things that you can get to. I'm not saying don't have hard assets, but make sure you're balanced. And the other thing is with all these profits, like you just said, well, right before the crash, I don't, Kirk, you said, what? I don't care. What if the markets hit their most expensive value ever? They just kept going up. Guess what just happened? All these profits that just hit, what did the stock market do? It exploded the other day.
Yep.
Well, Kirk, you want to talk about what the markets exploded? Who in the markets actually is doing really well? What's making up that incredibly successful S&P 500 return?
Yeah, I'm going to talk about that and one other thing here.
Did you miss your opportunity to get PPP money during COVID? Are you waiting for our president to forgive your student loans? Are you excited about helicopter money? Me too. If you want free money, look no further. I'm giving away free money this week on our show. All I ask is 5 or 10 minutes of your time. I'm so excited to give you free money, I can hardly contain myself. Take advantage of me and my excitement to get your free money. Go to www.moneytreepodcast.com/free money. Follow the instructions today and get your free money.
Apparently right now between Apple and Microsoft, it makes up 14.6 or something like that percent of the S&P 500. So two companies out of 500 are making up 14% of the index, which means 85%, 86% of the index is made up by 498 companies.
That's incredibly balanced, Kirk. And I mean, the way my mind translates that's balanced.
That's right, fair there. And balanced right there, just like our news, Doug. So I mean, we talked about that last week, so I don't take too much time, but I just want to point out that's kind of ridiculous. I do want to point out a few things. So Freddie Mac, we all remember Freddie Mac from 2008. Freddie Mac basically is coming out with a campaign to advise people that they should be buying more affordable houses. And if you live in LA, you should move to Sacramento. If you live in New York, you should move to Philly. If you live in Dallas, you should move to Houston. Now, to me, this is where the perspective comes into mind. If you're looking at Freddie Mac as your advisor, you probably should move to a different country. Maybe one like Russia that has a little bit more clear systems and communication. But, Freddie Mac came out saying this. I don't know that they could say it any more bluntly. Yes, things are way too expensive. Yes, you're paying $3,800 in LA. You can pay less than $3,000 a month in Sacramento. I'm pretty sure people in LA don't want to live in Sacramento. There are many other states they could move to if they don't live in LA. I think people are there for the location, not for the state. But that being said, if you look at this raises the point we've been talking about for close to 2 years now, which is affordability, affordability, affordability. People can't afford to live in some of these places, and they're going to have to move or not move in the case of their house. Because if you own a home and you have cash flow payments, none of this matters to you because you just keep paying your payment every month. And as Doug says, as long as you have liquidity, it's not a problem. But this is important because what I've seen in the last week, and this is pretty much since the First Republic takeover by JP Morgan, I've seen a lot of stories like this. Now, I'm pointing this out because this is not for all those of you who are data geeks like myself, you're going to look at this and say, yeah, that's not evidence. That's just anecdotes. However, from my experience, I can tell you anecdotes are really important in times like this because you don't have data until after. You don't know what's going to happen until after. anecdotes are a really important part. They should get your antenna going up and saying, all right, what's going on? I saw a rumor of First Republic getting taken over. I have an account there. Maybe I should think about it. To get an example, I think it was 2012 or 11. It was somewhere around there when MF Global went under. Now I had an account at MF Global. It was a futures account, and I just had it. I wasn't using it. It was just cash sitting there. I just wanted just to play around with it, and I don't know. I was playing around at one point, and then I just stopped because I was bored, and I just left it there. It was a few $1,000s. It wasn't a lot, and it was just sitting there in cash. And I saw on the news about MF Global, and John Corzine, who you might all remember, has a notorious streak of having companies go under, and he was running that company. And I started to see the stock price go down and down. And I was literally at a conference, sitting there watching CNBC, watching on the screen as the stock went down. And I was like, and there were rumors that there were some financial problems and this and that, and then John Corzine, and I was like, you know what? I really like that money and I want to have it. So I called up MF Global and I said, wire all of my funds to this account immediately. Less than 24 hours later, they shut the company down. And they shut it down, and my cash, I would have got it like 6 to 12 months later because, my cash was fine. But if you had futures, you might have been SOL. So the point being is that anywhere you go, there are risks that you need to understand. The futures market's risks are different from the stocks, which are different from bonds, which are different from every other market. So just try to understand what the risks are. I knew the risks for futures were, to me at the time, they were unknown, but they were greater than stocks. I knew what some of the risks were, but I also didn't know what some of them were, and I was uncomfortable with the fact I didn't know. So I just pulled my money and said, I'll figure it out later. Come to find out later, the risks that I was concerned but wasn't aware of were correct, which is there's not a lot of security for my assets there. So I'm glad I pulled it. But the point is I only did that because I didn't wait for somebody to say they're bankrupt. I said, hey, this doesn't look good. The market thinks it looks bad because they're tanking the stock price, and I'm gonna get my money safe. Now, I say this because there's a lot of this. So Freddie Mac is one example. There are many other examples we saw this week, and I'm trying to pull some, but I can't find them. Anyway, the point being is there's a lot of those, and keep watch. If you start seeing a lot of them, just be aware. It doesn't mean you should jump out your window. It just means that you should be aware that people are talking about it, and the talk could be a precursor to a problem. It doesn't necessarily mean there is, but people were look. If you look at 2008, right? Bear Stearns happened, AIG happened, a lot of those firms happened, but yet we had, what was that other firm that went before Bear? Lehman Brothers. Lehman Brothers. There were rumors of Lehman Brothers going bankrupt 6 months prior. I had some friends in the financial industry saying, oh, that company's garbage. I wouldn't touch them. And so the company, a few times, I remember it was the summer, I was getting a haircut and I saw it and the stock dropped like whatever it was, 30, 40%. I'm like, oh, wow, that's bad. And a few days later, it popped back up. Oh, everything's fine. Well, the point being is during times like this, it's what we call fog of war. We don't know what's going on. We hear things. We don't know if they're true, right? So when a news story comes out, like a perfect example is, oh yeah, Russia was attacked by Ukraine. Russian president was attacked by Ukraine with drones. Well, that must be fact. It came out of Russia, right? Everything out of Russia is true. Well, I look at that and say the likelihood of that happening is close to zero. First of all, they wouldn't have gotten through. They would have had to get through, bring the drones, get them all set up with munitions, and not have anybody notice it, nobody react to it. It was, to me, it seemed like 110% propaganda, right? But you don't know because it came out, and you might think, ooh, that's risky what they did there. But I'll bet a month later we find out, oh, Putin did that. Like just because he wanted to garner more, support for whatever he was doing. And he has like Russia Day or whatever it's called in like a week where they take their missiles and they show them off to everybody, like men, oh, look at my big missile. And they just show them off and look how strong we are. That happens every year and they have that coming up. So point being is you can't tell with the fog of war, right? You don't know. You just suspect and you're hearing news, which of course isn't news anymore. So you don't really know. So the point is you should be aware, but not run around like your hair on fire. So I want to point out a few things and give it to Doug to wrap it up. So this I saw this week, which I thought was interesting. I'm not really sure how they do it. I didn't run into the calculations, but this is how some people perceive a risk of probability of recession. So generally it's pretty low, But then at certain times, right before 2008, 2020, and right now, probability of recession is really high. Now, I'm not surprised by this. So I brought this because I don't know how they're calculating it. So I'm not going to present this as fact because I don't know how they're doing the calculations. They didn't say. But what I do want to point out is the fact that this aligns with how I see the world, right? So if you think about 2020, I remember the time where the global economy was shut down. How can you not have a recession, right? Who knows where the bottom of the stock market is? Who knows if you're going to be shut in your house for a year? Like, those are questions everybody was asking. So a recession was pretty much inevitable. But on this, it only reached about 35%. 2008, at the peak of 2008, 2009, it got to looks like around 40%. In year 2001, it looks like it peaked at around 45, 47%. Right now, we're at about 45, 50%. We're higher than any of those periods. And I'm not surprised. Here's why I'm not surprised by this. I'm not surprised by it because people have been talking about a recession for over a year. And they've been speculating that we're going to have a recession any day for a year. And while the jobs numbers today weren't great, they were somewhat expected, and the Fed still has their pedal on the brake, and they're not taking it off. They hiked rates this week a quarter of a point, between 5 and 5.25%, and they're at least going to keep it here for a while. Maybe they raise another 25. I don't know, but I think they'll probably pause next month, and next time they have their meeting. I don't know if it's next month. I think it is, but they're going to do probably a pause, and then they'll see what happens. I think everyone expects that. I think that's reasonable, and I think they should do that if they're worried about inflation. We don't have a recession. It's been a year, and the Fed's been rocketing rates higher. So are we going to have a recession? I would say if we don't have one, I'd be shocked. And I also want to point out one more chart here before we go, which is it's just really about AI. And this is also something you should take with a grain of salt, which is IBM to pause hiring to plan to replace 7,800 jobs with AI. Now, I only bring this up because it's such big news. And of course, I want to jump on the bandwagon. No, that's not the reason. I bring it up because people are really scared about the implications of AI. I've talked to a lot of people recently about it, and I certainly have my concerns. I think it's going to go slower than people think. I don't think people's jobs are going to disappear tomorrow. But I do think it's a big problem over the next 5 years, and I think people need to be aware of it. IBM saying this is interesting, but what I think is really the case is what they're saying is we're going to not hire or potentially lay off people in the next year, and we're going to cloak it with AI. Oh, it's AI is the reason we're not doing it, and I think that's probably more likely the case because they don't want to say that they're laying people off. They're saying, well, it's AI. AI is the problem. So you're going to see a lot of that now. I've seen a ton of this. I see it almost every week where companies like, yeah, we're going to stop hiring. We may let some people go because of there's like COVID running through the company, whatever it is. I don't have an excuse off the top of my head, but these companies are really good at changing the perspective from reality to what they want you to think. So I don't personally think that AI is the challenge here. I think it's just that they have to lay people off like every other company, especially in tech. Now, is AI going to destroy jobs? Absolutely it will, but it's not going to do it in the next 60 days and certainly not in the next year. I think it will definitely change the landscape. And I think for all of you who need something to think about this weekend over your margarita and Cinco de Mayo, think about how your job could change in the face of AI because all of our jobs are going to change. So Doug, why don't you wrap it up and then I'll take us home.
Well, I think one of the first areas you're going to see AI have an impact on people is copywriting. And we're already seeing that with ChatGPT. I mean, there's going to be a lot of people involved in the web development or the online marketing space that I think should be a little bit nervous. And again, anywhere where there's going to be at least, it's got a long way to go in terms of graphic design. I laugh sometimes because there are some bots out there that'll do AI regeneration of a topic, and the humans that are created in it would probably look funny if they were aliens from another planet to those aliens. But when it comes to copywriting and text, it's going to get harder and harder to disseminate, and it's going to be harder and harder to justify the cost of spending on people to do it as it gets smarter. One thing I also want to talk about these job changes, and I think this is a really important thing for people to note. If you have a 401k loan out there, you need to do everything you can if your job has any sense of uncertainty to pay that off. Just an awareness on 401k loans, if you leave, they are due immediately, and they can be assessed as a potential as a distribution with, again, under 59.5. That's taxes and penalty. So you want to face that. 401k, a lot of people use 401k loans as an access to capital source. It is certainly one. There's question. It's arguable whether it's a good one. The other thing too is the Wall Street Journal published today, recently, that there's a change in the prime interest rate because of rates going up, and now that's going to go from 8 to 8.25% effective May 4th. That means that loans from 401ks are going to either switch to this prime rate or prime plus the stated percentage. So now these 401k loans, Kirk, some of those loans that are out there that people got at 4, 3, 4, 5% have now variably moved up to the 8.5 to over 10 plus range. And that's I think that's one thing that those rackets just crashed on me. That's one thing I think we're not going to necessarily the people aren't talking about enough yet, and we can address that at another time. Listen, if you want to find out a little bit more about where I come from, you can see on the hat here, ProCollege Planners. If you've got a kid going into college, talking about interest rates, talking about liquidity, definitely check us out. Go to procollegeplan.com, download our free checklist. But also want to address kind of business owners today. Look, you as a business owner, you do not need inspiration. You already have a vision you're working on. A lot of business owners will get their advice from other entrepreneurs. Listen, I'm an entrepreneur as well. You may be out there as a business owner working with a revenue growth advisor, and that may not be the person that you really should be working with to grow your business. Listen, because I have a business, I don't focus on growth. I'm looking for, and that means looking at revenue. I've got revenue. What I've discovered is I want to treat my business like an asset in a portfolio. And that's how you probably look at your business. It's an asset in your portfolio. And once I did that, it was a game changer for me. And if that is something that you view and you want to maximize the asset you have, then look, you need the tools to do so. And one of the great tools, you can get some information at automaticbusinessmethod.com. Go out there, download the free checklist there for business owners that want to maximize their business as an asset. And really, what is a true investor? A true investor is someone that has an asset that they don't have to spend their life working on. And you got into this to enjoy the fruits of your labor, the fruits of their asset, and there's some great ways to make that business work for you. So go out, automaticbusinessmethod.com, free checklist, learn more, make your business an asset that is going to work for you.
Great. Well, thanks for coming on, Doug.
That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.